What's up, you guys? It's Graham here. And we're Look, I'm gonna get straight to the point. Despite Trump's push to lower interest rates, as of a few hours ago, Jerome Powell once again defied orders and left rates unchanged during one of the craziest markets that I've ever seen. For instance, as a result of higher interest rates, the bond market has completely collapsed to a point that we haven't seen since the 1970s. The stock market is back near its all-time high, despite the ongoing conflict and escalation throughout the Middle East, as the United States continues to print endless amounts of new money. And the underlying problem has gotten so severe and unsustainable that Ray Dalio is sounding the alarm on the US economy. That's why it's absolutely crucial that we talk about exactly what Jerome Powell just said about lowering interest rates, why the bond market collapse could happen sooner than you think if it's too late to buy into stocks now that prices have almost completely recovered, and finally, what this means for you watching, especially if you want to come out ahead profitable. Although before we start, I'll make you a deal. If you hit the like button and subscribe if you haven't done that already, I will do my best to read and reply to as many of your comments as I can. Yes, I understand it gets annoying when I ask for it, but it does help out the entire channel tremendously, and if you don't believe me, just leave a comment and see what happens. So thanks so much, and also big thank you to Kickoff for sponsoring this video, but more on that later. Alright, so in terms of why the Federal Reserve decided not to lower interest rates, it all comes down to three letters. It sends chills down every investor's spine. CPI, or the Consumer Price Index. Essentially, this tracks the rate at which products and services increase or decrease in price over the last month and year. And as of recently, it was found that prices rose just 0.1% month over month, putting the annual inflation rate at just 2.4%, below expectations. In this case, most of the decrease came from lower energy prices, which fell 1% over the month, and most of the increase came from housing, which is still up 3.9% from a year ago, the lowest increase since 2021. Good news, right? Well, it's theorized that one of the reasons we're not seeing more inflation yet, despite tariffs being in effect, is that most businesses pre-purchase their inventory ahead of time to reduce their cost, and as one analyst pointed out, tariff-driven price increases might not feed through to the CPI data for a few more months, so it's far too premature to assume that the price shock will not materialize. Or basically, even though this inflation reading was decent, we're not out of the woods quite yet. On top of that, core CPI, which excludes food and energy, hasn't budged in the last 3 months from 2.8%, both a sign that things aren't getting worse, but they're also not getting that much better, especially now that oil prices are rapidly increasing, which could very well push these inflation numbers back up again. Although keep in mind that rising prices are only one aspect that people need to consider, because this next topic is telling us something entirely different, and that would be the bond market. See, for those unaware, bonds are typically the most stable part of investing. You loan the government your money, they pay you back with interest, and over the course of history, they have never not paid back their debts on time as agreed. Except recently, the Treasury bond market has completely collapsed, with losses that we haven't seen in over 250 years, having fallen as much as 46% in value, which for government debt is absolutely insane. How does this happen? Well, it's important to keep in mind that the price of a bond goes down when interest rates go up, because why would someone pay you full price for a bond that makes 2% when they could just go out and buy a new bond that pays 6%? This is why when the Federal Reserve raised interest rates at the fastest pace ever in history, bond prices tanked because everything that was previously issued was completely made obsolete. Like, think of it this way. Imagine you bought a $100 bond paying 2% interest over 10 years. In this case, you get paid back $121.90 by the time the loan gets returned. But what happens if once you locked in your 2%, the exact same loan started offering new investors 6%? Well, this means for somebody to make the same 6% return that they could buy today, they'd have to buy your old bond for only $70.56 just to match what they could get buying a new bond paying the higher interest rate. And this is where the problem begins. Number one, we have the banking industry. Because banks often place customer deposits in bonds that happen to be locked in during a time when interest rates were historically low, they're now sitting on some of the largest losses in banking history, essentially being forced just to hold or risk losing a ton of money. In fact, this was the entire reason for the collapse of Silicon Valley Bank, which leads us to two: United States debt. Typically, U.S. Treasuries are seen as the risk-free rate of return, since what's more guaranteed than the government paying back what they borrow? But what we're actually seeing is that both the 10 and the 30-year loan terms are having to pay more money just to get people to buy them, signaling that investors now demand more money for the risks of endless money printing, growing deficits, higher than expected inflation, and the increasing likelihood that the USA is just not as attractive as it used to be, which then results in number 3, the dollar crisis. Unfortunately, some investors worry that there's a bit of a snowball effect here, because as government debt gets bigger, investors' concerns increase, causing them to demand higher interest rates, causing the government to issue more debt, causing investors to demand higher rates. You see where I'm going with this. Essentially, there's no easy way out of it other than printing more money and devaluing the dollar. Of course, in terms of where this leaves us today, the bond market has fallen so much that the US stock market is now 50% larger in comparison. Again, a level we haven't seen since the early 1970s, right before stagflation and falling prices. But hey, on the bright side, some investors believe that there could be huge opportunity right now for bond investors because you're able to get some of the highest interest rates that we've seen in almost 20 years. Or I guess put another way, some analysts believe that stocks are trading at overly optimistic prices and bonds are overly pessimistic, leading to a potential rebalancing opportunity to arbitrage the difference and make a ton of money, if everything goes right. But if it goes wrong, well, that's something we have to talk about. Although before we go into that, while we're on the topic of building wealth, it's important to realize that it's not just about how much money you make, but instead how you manage what you already have. The fact is, everything from the interest rate you get on a mortgage, to whether or not you get approved for a credit card, to even if you're able to rent an apartment, all depends on one thing: your credit. This is why optimizing your finances all starts with building your credit the right way, which is where our sponsor, Kickoff, is there to help. For those unaware, Kickoff is a credit building tool designed to make it simple and affordable to build a strong credit foundation. Plus, there's no credit check to sign up, no interest, and no hidden fees. Their monthly plans start at just $5 and is created to help improve key credit factors like on-time payment history and lowering your utilization. Even better, but those on-time payments get reported to all 3 major bureaus, and with autopay, it's pretty much effortless. This is why Kickoff users with credit below 600 saw an average increase of 25 points in their first month and up to 84 points after 1 year simply by keeping up with their payments. Without exaggeration, I have seen firsthand just how important it is to have good credit. Like, it's the only reason how I was able to get multiple 2.8% fixed rate mortgages back in 2020. It's how I was able to get the best rates possible to leverage my money to make even more money. And if you don't make an active effort to get this part of your life handled, it could easily cost you in excess of tens of thousands of dollars over the course of your lifetime in interest you didn't need to spend. So if your credit's holding you back, Kickoff is one of the best ways to begin turning things around. And they're offering you 80% off the first month, which works out to as little as $1. All you need to do is visit the link in the description or go to getkickoff.com/Graham to get started today. Enjoy, thank you so much, and now let's get back to the video. All right, now in terms of what could go wrong, look no further than tariffs. Now, even though President Trump has very publicly called for Jerome Powell to lower interest rates, with the consideration that job growth has slowed down, it appears as though the Federal Reserve is holding very firm, mainly because we have no idea what could happen with tariffs. And let's be honest, anything could still happen. For instance, last month, Jerome Powell said that if the large increases in tariffs are sustained, they are likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent, leading them to take a wait-and-see approach that's resulted in absolutely nothing being done. In addition to that, potential supply shocks are keeping Jerome Powell and the rest of the Federal Reserve to play it extremely cautious, because they know if they lower interest rates and inflation reappears, they would lose all credibility, and that's the foundation to keeping the markets relatively stable. On top of that, we also have to address the possibility of oil prices continuing to go higher, which threatens to completely derail the progress of lower inflation. Thankfully, though, it does appear that talks between the United States and China are going overall incredibly well. Other countries are seemingly on board and trying to work something out, and hopefully soon we could reach some level of peace or resolution throughout the Middle East if negotiations go well. But it is worth mentioning that some analysts are warning that the Federal Reserve may have to choose between fighting inflation with tighter monetary policy or cutting interest rates to support growth and employment, which, according to headlines right now, is the result of 25% of Americans being what's called functionally unemployed. Now, if this is the first time you've ever heard this term, don't worry, me too. Essentially, a large portion of the population is not being counted as unemployed because they were not actively looking for work during the 4 weeks preceding the survey or were unavailable to take a job. On top of that, the headline employment number counts you as employed as long as you've worked 1 hour over the prior 2 weeks, which is a pretty low bar. So they say a better metric to gauge is the functionally unemployed, which includes those working poverty wages or those who can't get full-time work of more than 35 hours a week. Thankfully though, you watch my channel and don't have to be misled by twisted narratives, because when I saw this, I had to do my own research to figure out what's really going on. And even though this 25% functionally unemployed headline seems disastrous, when you really look into it, you could see that this number is actually near an all-time low, and it was as high as 33% throughout the 1990s. So no, the 25% functionally unemployed headline is not as big of a deal as they make it seem to be, and it's actually not as bad as it was throughout the last 30 years. But it is something to keep an eye on. And in terms of what Jerome Powell has to say about all of this, as well as when they expect to lower interest rates, here's what you came for. Like I mentioned earlier, the Federal Reserve decided to once again pause interest rate cuts for the foreseeable future, with the expectation that we're now going to see our first rate cut occur in September at the very soonest. Why? Well, their main concern is the inflationary impacts of tariffs, combined with the uncertainty of what could happen in the Middle East, which very much affects all of us in the United States, even if indirectly. After all, the situation seems to be changing so rapidly that it could be entirely different an hour from now. This is why the Fed has reiterated that they want to play it safe, only cut interest rates once they know 100% that inflation's not returning, and then take it meeting by meeting afterwards, depending on the data. In addition to that, today is the day in which they release what's called their Summary of Economic Projections, which estimates where they anticipate seeing employment, inflation, GDP, and interest rates over the next few years. In this case, they believe that inflation will eventually return to their 2% target, but not until after 2027. They've also revised GDP down to just 1.6% in 2026, and just like we expected, they anticipate higher interest rates for longer, with an estimated federal funds rate of 3.4% in 2027. Basically, this means that they expect slightly higher inflation, slightly slower growth, and that's going to result in only 1 or 2 rate cuts this year, with maybe only 1 next year. That's it. From my perspective, it just seems like they want to have room to cut interest rates if and when something breaks within the economy. And if they lower interest rates preemptively, they have less to work with in the future. Obviously, all of this is going to affect the entire trajectory of our economy, and we're going to feel its most immediate effects on none other than the stock market. First of all, despite tariff concerns, recession worries, and economic uncertainty, I think it goes without saying that the rebound in stocks has been one of the most impressive bull runs of the century. But I think the million-dollar question now becomes, can it continue? Well, let's first start by covering the downside. First, a record high 38% of S&P 500 companies gave negative guidance for future quarters, while only 15% issued positive guidance, which is the widest negative to positive guidance that we've seen since the 2008 financial crisis. Second, GDP declined by 0.3% in the first quarter, and if growth continues to decline, stocks should follow. Third, tariffs have so far just been an endless back and forth of nonstop threats and 90-day pauses, but if higher than usual tariffs were to stick, that could lead to a panic sell-off and the stock market to fall even further, leading us to 4. Stocks are still richly valued, currently trading at 20 times earnings, which is historically high given the current interest rates. And 5, we have no idea what could happen in the Middle East, how long this continues, or to what degree the United States gets involved. Again, the situation is changing so rapidly that I'm just trying to keep details to a minimum so that this part doesn't become outdated. But on the bright side, inflation is very slowly cooling down, corporate earnings are still strong, investors have $7 trillion worth of cash sitting on the sidelines, and once tariffs are sorted out, the market should, in theory, continue marching higher. On top of that, huge shout out to Ryan Detrick on Twitter. I started following him earlier in the year, and I have to say, he has had some of the most comprehensive and accurate analysis on the stock market that I have seen. And as he points out, so far, every time the market has gained 20% in 2 months, the following 12-month returns have always been up by an average of 30%. Yes, it's true that past history doesn't always indicate future performance and anything can happen, but it does give us the the realization that the market can keep going up higher, even though it seems like the economy is always on the brink of destruction. That's why if you've been watching my videos, I've always been a huge advocate of just buying the market on a regular basis and holding. And if the market drops, it's a great opportunity just to keep buying in a little less. Even investing at all-time highs is still shown to be profitable, and you're more likely to see even higher highs investing at all-time highs. That's why the cheesy saying of "it's time in the market, not timing the market" is so true. And without a crystal ball, the best time to be investing long-term tends to usually be right now. That's why in terms of what I think about everything, I tend to believe that we'll likely see a 25 basis point rate cut at some point this year if conditions permit. And if they don't, I have no doubt the Federal Reserve is going to keep interest rates steady regardless of what Trump says. Now, objectively, I do tend to agree that the United States is on an unsustainable path when it comes to endless money printing. But I also understand that I would be very stupid to expect any sort of meaningful change or bet against them anytime soon. Like, according to the billionaire Ray Dalio, the United States is on an unsustainable path, and there are only 3 options to fix it. 1 would be to increase tax revenue, 2 would be to cut government spending, and 3 would be to lower interest rates so that interest payments on the national debt don't balloon out of control. On top of that, all 3 of these would have to be implemented at the exact same time. Otherwise, it would be too much for the economy to handle. Could it be done? Absolutely. But will it? I highly doubt it, especially when it's easier just to keep pushing it off to future generations and let them deal with it. This is why I've taken the approach just to continue investing, and history has shown that over time, things eventually balance themselves out. Plus, it's important to reiterate that I'm not going all in on one thing. Like in my case, I have about 30% of my money in real estate, 35% in stocks, spread 80-20 between the USA and international, 10% in a Bitcoin ETF, 20% in treasuries earning 4.5%, and the rest in alternative investments that aren't correlated whatsoever with the rest of the market. Yes, there is opportunity cost in keeping money in treasuries, but I also, at this point, just value peace of mind rather than maximizing every dollar. So this is my entire plan for what I'm doing. Beyond that, though, like I said earlier, the situation in the Middle East deserves its own video, and the entire situation is changing by the hour. And as much as I would like to see this resolved as fast as possible, it's still too early to tell. Feel free to let me know what you think of all this down below in the comments section, and like I said, I will do my best to read and reply to as many of you as I can, as long as you hit the like button and subscribe. So thanks so much for watching. Also, big thank you again to Kickoff for sponsoring this video. Their information is down below in the description if you want to improve your credit. Thanks so much, and until next time.